Well, there's been a lot of talk lately about silver entering some kind of completely different market, not just another rally, not just another chart breakout, but a real change in how people think about physical metal, paper contracts, and the dollar itself. So in this video, we're going to separate the exciting part from the useful part, and you're going to walk away with a much clearer view of what could actually drive silver and gold from here. Today is Saturday, April 25th, New York time, so comment the day and date you're watching from. And real quick, if you value my content, support the channel by subscribing and comment John A.G. Best. It helps push the serious analysis past the noise. Now, the number everyone wants to talk about is $500 silver. That's the big shiny headline. But if we start with that number, we are starting in the wrong place. The real question is not, can someone say a wild number on camera? Anyone can do that. The real question is, what kind of market conditions would make a number like that even enter the conversation? And that's where this gets interesting. Because the bullish silver case right now is not just based on hype. It is built around a few pressure points happening at the same time. Physical supply is tight. Mine growth is slow. Investment demand is waking back up. Paper trading is still enormous. Gold is acting less like a sleepy commodity and more like a global trust meter. And in the background, people are starting to ask a very uncomfortable question. What if the paper price is not the whole story anymore? Let's start with supply, because this is where most people oversimplify things. When silver prices rise, people assume miners will just produce more silver. Higher price, more incentive, more supply. Easy. Except silver does not work like a vending machine. You do not put in a higher price and immediately get more ounces out the bottom. Mines take years. Permits take years. Ore grades decline. Costs rise. Energy gets expensive. Skilled labor is limited. And then, to make it even messier, most silver is not mined from pure silver mines. A large share comes as a byproduct from copper, lead, zinc, and gold operations. So even if silver gets everyone excited, the actual mine plan may still depend on a completely different metal. That matters a lot. Based on recently published numbers, primary silver mines are only part of the total picture, while a bigger portion still comes from these mixed metal operations. That means silver can be screaming for more supply, while the mine owner is looking at copper margins, zinc demand, or gold grades and saying, okay, but that doesn't change our schedule tomorrow morning. So when people point to Mexico, they are not wrong. Mexico is still one of the most important silver countries in the world. If Mexican output struggles, that matters. If Mexican mines underperform, that matters. But we also have to avoid turning every soft quarter into a guaranteed crisis. A production dip can come from lower ore grades. It can come from maintenance. It can come from mine sequencing. It can come from labor problems. It can come from weather, security, processing bottlenecks, or simple geology. And sometimes the mine still keeps full-year guidance, even after a weak quarter. So the lesson is not one report proves silver is about to disappear. The lesson is that silver supply is not flexible, it is slow, it is stubborn, it is complicated, and in a tight market, slow supply can become a very big deal. Now add the broader deficit picture. The latest industry outlook still points to silver staying in deficit again this year, not for the first time, again. That means total demand is expected to run above total supply, even after prices have already done a lot of work. And yes, some demand is cooling because high prices change behavior. Jewelry demand can soften. Silverware demand can drop. Industrial buyers can thrift. Solar manufacturers can use less silver per panel. That is real. But here is the important part. Even with those pressure valves, the market can still remain tight. That tells you the system is not just fighting one problem. It is fighting several at once. Investment demand can rise while industrial demand slips. Recycling can increase while mine production fails to surge. London liquidity can improve one month and still look fragile the next. This is not a clean story. It is a tug of war, and that tug of war is exactly why silver is so volatile. Now, China. This is where people need to slow down and listen carefully. There is a claim floating around that China stopped exporting silver entirely. That sounds enormous. That sounds like the whole market just lost a secret supply valve. And if it were that simple, yes, it would be a major turning point. But the latest public reporting makes the story more complicated than that. China has named approved companies allowed to export silver over the next couple of years, and that directly challenges the clean version of the claim that exports simply went to zero forever. So instead of repeating the most dramatic version, the better way to say it is this: China is not irrelevant to silver supply. China is central. But China is not a one-sentence story. It may import aggressively in one channel, export through another, retain more metal for domestic industrial use, and still allow certain approved companies to ship product under specific rules. That is not as catchy as shouting zero exports, but it is closer to how global metal flows actually work. And this matters because silver is now tied to strategic industries: solar, electronics, vehicles, data centers, power grids, defense-related electronics. These are not cute little side uses anymore. These are parts of the modern economy. So if countries decide they want more control over critical inputs, silver becomes more political than people expected. That does not guarantee a shortage tomorrow, but it absolutely changes the tone. Now let's talk about paper silver, because this is where the conversation gets emotional. People see huge paper volume and say, look, the market is fake. And I understand why. When a paper market can trade volumes that look enormous next to annual mine supply, it feels absurd. It feels like a casino sitting on top of a warehouse. But we need to be precise. Paper volume is not the same thing as delivery demand. A futures contract can be a hedge. It can be a spread. It can open and close quickly. It can represent a bank managing risk, a producer locking price, a fund speculating, or a trader getting stopped out before lunch. So no, you cannot take one giant paper volume day and assume every ounce wants to leave a vault. However, and this is important, paper volume still matters because it shapes price discovery. If the paper market sets the price, but the physical market starts refusing to behave, then the tension grows. The problem is not that paper exists. The problem is what happens if confidence in paper claims falls faster than physical metal can move. That is where a squeeze can become more than a slogan. Now, the margin cut story fits right into this. The exchange recently lowered margin requirements for major precious metals contracts, including silver. Lower margins usually mean traders need less cash to hold the same type of exposure. That can bring in more activity, it can increase liquidity, it can also increase leverage. But don't confuse cheaper access with automatic upside. Lower margins can help bulls, yes, but they can also help shorts, hedgers, spread traders, and anyone else who wants to operate with less capital tied up. So the real question is not just, did margins fall? The real question is, who steps in after they fall? If momentum traders come in hard, silver can move fast. If hedgers use the moment to cap risk, the move can get messy. That is why silver can look bullish and still punish impatient people. Now let's bring in gold, because silver does not live alone. Gold has been acting like the adult in the room. It has already told us that big money is nervous. Global gold demand recently reached record territory, and central banks kept buying meaningful amounts even after a massive price advance. That is not normal retail excitement. That is reserve management. That is long-term positioning. That is institutions saying we want an asset that is not somebody else's liability. That is the deeper message. And it is hard to ignore now for serious investors. When trust is strong, investors love yield. They love paper. They love convenience. When trust weakens, they start asking what they can hold, what they can settle with, what cannot be printed, and what does not depend on another party keeping a promise. Gold answers that question first. Silver answers it differently. Gold is the anchor. Silver is the torque. Gold moves when the system gets nervous. Silver can move when the system gets nervous and the physical market is already thin. That combination can be powerful, but it can also be violent. Silver does not glide. Silver jerks, spikes, dumps, reverses, and then makes everyone question their plan. So if you're looking at these huge silver forecasts, do not treat them like guaranteed destinations. Treat them like stress test numbers. Ask what would need to happen. You would probably need persistent deficits. You would need physical investment to keep rising. You would need industrial demand to stay resilient enough that thrifting does not solve the problem. You would need inventories to keep getting drawn down. You would need the gold market to stay strong. And you would need some kind of confidence break between paper promises and physical ounces. That's a lot. Could it happen? Sure. Is it guaranteed? No. Definitely not. And this is where I want to challenge the most aggressive version of the silver story. If prices rise too quickly, the market does respond. Scrap comes out, jewelry demand weakens, silverware demand gets crushed. Manufacturers redesign, solar producers reduce loadings. Investors who bought lower may sell into strength. Dealers may see two-way flow. In other words, the market has breaks. But breaks are not the same thing as a brick wall. They can slow the move without stopping the trend. That is the balance. The bullish side says supply is too slow and trust is fading. The skeptical side says high prices create their own resistance. Both sides have a point. The investors who survive are the ones who can hold both thoughts at once. If you're successful, share your success story in the comments so others can stay motivated. There is one more piece people miss. Silver inventories are not all the same. Some metal is sitting in exchange warehouses, some is tied to investment products, some is already spoken for, some is available, but only at the right price, in the right location, with the right paperwork. So when someone says there is plenty of silver, you have to ask, plenty where? plenty for whom, and plenty under what conditions. That sounds like a small detail, but it can decide everything. A market can look comfortable on a spreadsheet and still feel tight to an actual buyer who needs bars delivered quickly. Location matters. Bar size matters. Refining capacity matters. Financing costs matter. Lease rates matter. Shipping and insurance matter. In precious metals, the word available is doing a lot of work. And notice the irony here. The same higher price that attracts new buyers also scares away weak demand. That is why silver does not move in a straight line. It breathes. It shakes people out. It convinces the crowd the move is over. And then, if the fundamentals are still there, it forces everyone to reprice the story again. And that is why investor psychology becomes so important. When people believe metal is easy to get, they wait. When they believe metal is getting harder to source, they move faster. That faster movement can create the very tightness everyone was worried about. Not because the world ran out of silver, but because confidence ran out first. That is how small stress becomes big stress. Now, what should we actually watch? First, watch physical premiums. Not just the headline spot price. Watch what real buyers are paying for real metal. Second, watch London liquidity, because that market can tell us whether large bars are easy or hard to source. Third, watch investment demand. If bars and coins keep strengthening while price stays high, that is different from a normal rally. Fourth, watch industrial demand, especially solar, electronics, vehicles, and data center-related consumption. Fifth, watch gold. If gold keeps behaving like money, silver will keep attracting people who want the more explosive cousin. And finally, watch inflation and real rates. Because if inflation stays sticky while confidence in policy weakens, precious metals do not need a perfect story. They just need investors to doubt the alternatives. Cash loses purchasing power, bonds carry duration risk, stocks can be expensive, real estate can be illiquid. Suddenly metals, which looked boring for years, start looking like insurance again. But insurance is not entertainment. You do not buy insurance hoping your house burns down. In the same way, you should not root for the silver market to break. A broken market sounds exciting until you realize rules can change, spreads can explode, taxes can appear, dealers can step back, and price discovery can get ugly. You don't want chaos. You want repricing. You want functioning markets to slowly admit that physical ounces are harder to replace than paper claims. That is the healthier outcome. So yes, the silver story is serious, the supply side is tight, the deficit pattern matters, China matters, margins matter, paper volume matters, gold demand matters, inflation matters. But the correct takeaway is not blind panic, and it is not blind disbelief. The correct takeaway is discipline. Silver is sitting at the intersection of industrial demand, monetary distrust, constrained supply, and speculative leverage. That is an unstable intersection. Most days, traffic passes through. But when something goes wrong, everyone suddenly claims they saw the crash coming. So do the work before the crash. Thank you for watching. Subscribe if you want calm breakdowns in a loud market, and comment what you think drives the next big silver move first: physical demand, paper market stress, or inflation. This video is for education and discussion only. I am not telling you to buy, sell, hold, or chase anything. Markets can move against smart people, loud people, and careful people. So think independently, manage your own risk, and make financial decisions that fit your own life.